What is up? It is Big Char Trades back with another video, and in this video I'm going to tell you everything you need to know about liquidity. Right? This is going to be a simplified video about liquidity. A lot of new beginner traders are confused as to what liquidity is. So in this video I'm just going to explain what liquidity is, why it matters, the different types of liquidity, how it works, and then how to use liquidity in your everyday trading. So before I get into anything, I want to explain to you what liquidity actually is. Okay, so liquidity is where the money is in the market. Okay, think of it as hotspots or magnets where traders place their stop losses or pending orders. Okay, the market moves to these hotspots, right, to these liquidity hotspots to grab that money before making its real move. Okay, here's why it matters. Right, liquidity matters because the market needs liquidity to function. Right, it's how big players like banks get their trades filled. Price is drawn to areas of high liquidity like a magnet, so understanding liquidity helps you predict where price will go next. Okay, let me show you what liquidity looks like on the chart. We are on the daily time frame. Let me drop to the hourly so you have a better idea. So liquidity is any of these highs and lows. Okay, so we have liquidity at this high, we have liquidity at this low, right? We have liquidity at this low. Okay, we have liquidity at this high. Okay, and all of these liquidity points tell us what price is doing. Okay, so there are two types of liquidity: buy side liquidity and sell side liquidity. There's also internal and external liquidity as well. In this range right here, right, I'm talking about this range that I have selected, our external liquidity levels are, let me zoom out for a second here, this high right here and this low right here. Okay, these are external liquidity levels because these liquidity levels have not been swept through yet. Okay, our internal liquidity is any liquidity inside of this range. So this would be internal liquidity, right? This would be internal liquidity. This would be internal liquidity, right? All of these liquidity points are internal liquidity levels. Okay, this is also internal liquidity right here. Okay, internal liquidity that we swept through. Okay, all of these are internal and external liquidity levels. Okay, remember, the market needs liquidity to function. It's how banks and big, companies, right, big hedge funds get their trades filled. Okay, so buy side liquidity is at the top of the range. Okay, these are where all the buy stops are. Okay, so this is buy side liquidity, and sell side liquidity is at the bottom of the range. Okay, so whenever somebody mentions, or whenever I mention sell side liquidity or buy side liquidity, I'm referring to highs and lows. Okay, sell side liquidity when I'm referring to lows, buy side liquidity when I'm referring to highs. Okay, so the way that liquidity works is that imagine a group of traders place stop losses just above a recent high, right? The market spikes up, hit those stops, which is grabbing the money, right, and then reverses. That spike is called a liquidity sweep. So you can see that right here. Actually, a great example on the hourly time frame. See, we have this internal range liquidity right here. What does price do? Price comes up, sweeps it with this high, and then immediately dumps. Okay, and this happens on every single time price reverses, price sweeps liquidity on every single time frame. So if we go to the 4-hour time frame, what happens here? Price swept these lows right here. Sell side liquidity, right? Price swept it right here. And what did price do? Price went ahead and went all the way up here, right? Okay, so as you can see, price is always sweeping liquidity before making a major move in either direction. Okay, and then we dumped because price went ahead and traded into this internal range liquidity that's right here. Now, I'll get into internal range and external range liquidity a little bit later in this video, but I just want you to understand overall what liquidity is so you can start using it every single day, because it's really fucking important that you use liquidity every single day. Okay? You're going to always start with the big picture, okay? The higher time frame liquidity matters more than the lower time frame, okay? So you're always going to want to find major liquidity zones, okay? Remember, like I just said, these zones are like magnets. So for example, what happened here? you see that price made this low, immediately traded up, and then what happened? It got pulled in back to this low like a magnet, right? You see that traded up, right? Reacted from this internal range liquidity level, and then traded back into this low, reacted up, traded back into this internal range liquidity level, traded back to this low. Okay, so there you go. You're also going to use the lower time frames for execution. Obviously, you can't execute a trade off the daily time frame. But I'll get into that in another video. I have like a little checklist pulled up next to this video while I'm making it, so I remember to cover everything. Okay, so what did we cover so far? Okay, we covered buy side liquidity, sell side liquidity. Right, we covered internal range liquidity, or internal and external liquidity, right? And external liquidity. Okay, we covered how liquidity is basically like a magnet for price. So now I want to cover internal and external range liquidity and how it's the only direction in which price moves. Okay, so external range liquidity and internal range liquidity can be used for daily bias. So if you've watched any of my previous videos, you know that I talk a lot about using candle closures for daily bias, right? But IRL to ERL and ERL to IRL, right? IRL being, here, let me write it out. IRL, internal range liquidity, and then ERL is external range liquidity. You have to understand that price only moves from IRL to ERL and ERL to IRL, right? It doesn't bounce around from internal range liquidity to internal range liquidity. It doesn't bounce around from external to external. It always moves from internal to external and from external to internal. So how do we find internal liquidity levels? Because not every single internal liquidity level is valid, right? So, for example, if there is an internal liquidity level next to a low that price just swept, right? That wouldn't be a high probability internal liquidity level because it's just not. So this fair value gap, right? You see price went ahead and swept this low right here, right? Price would not target this internal range. It would target this internal range. Or no, not this internal range. This internal range. But why? But why would it target this internal range? Now I'm going to describe to you why, and I'm going to describe how you can use internal and external range liquidity levels every single day when you trade. So I'm just going to make this really easy for you guys. Okay? I'm going to draw out external range liquidity, obviously. It's external range liquidity, right? Let me put this right here. Okay? And then external range liquidity right here. We're going to use this as an example. Okay? So, we have these two external range liquidity points. Okay, this is all we have. Right? Imagine that price hasn't done this yet. Okay, so, all right. So this is all we have. How do we find the internal range liquidity that would be valid? Well, first thing we do is take the 50% fib and we draw it out for the range. Okay, this is called our premium. Our equilibrium price. This is equilibrium. Anything above equilibrium is premium, and anything below equilibrium is discount. Price is always trying to find a balance between premium and discount, and it oftentimes overcompensates, right? So price put in this external range liquidity, right, inside this fair value gap over here, and then it traded right into this internal range liquidity point right here, okay? So how do we know that price is going to trade back to the downside? Well, first of all, we are inside a bearish fair value gap. Second of all, we are also in a premium. And what did I just say that price loves to do? It loves to be in equilibrium. So whenever we're in premium, price is always constantly trying to go back to that equilibrium level. Whenever we're in discount, price is constantly trying to go back to that equilibrium level. Okay, and it typically overcompensates. So since we can anticipate price to move from internal range liquidity to external range liquidity, because that's how price moves, we can anticipate price to trade inside of this internal range liquidity level, right? This is premium. Okay, this premium array. We can anticipate price to trade into this premium array and then trade back into this external range liquidity at this low. And what happens to price? Price rejects and trades right into that external range liquidity level. Okay, so now, since we just made the IRL to ERL move, right, internal range to external, what can we anticipate? We can anticipate another IRL to ERL move, or ERL to IRL move, because we swept external range. Price only moves from external range to internal range. What do we have here? Well, on this move down, we put in this nice bearish fair value gap that is sitting right at premium. Okay, so it's sitting right at equilibrium, but it's in premium still. So price only moves from external range to internal range. So what can we anticipate? We can anticipate price to come inside of that array, which it does, right? It sweeps internal range liquidity. And now, where does price go? IRL back to ERL, right? So what happens? Sweeps into premium, comes right back into discount, and ends up here as of now. So this is how powerful liquidity is. You literally, using liquidity, you know where the magnets are, and you can anticipate where price is going to go based on these magnets. Okay? But you have to remember that when you're dealing with liquidity, higher time frames are way more significant than lower time frames. Okay? This is on the daily time frame. Right? We could have easily had some IRL to ERL bullshit move on the 1 minute. The 1 minute holds no significance compared to the daily. Okay? No significance. We always, on the 1 minute, there are constantly changes in states of delivery getting disrespected. There's so much shit going on the 1 minute chart. So much shit going on the 5 minute chart, even the 15-minute chart. Okay? So whenever you're using liquidity to trade, you must use the higher time frames to establish a narrative, and you must wait for a lower time frame. Here, actually, I'm going to get into entries, right? Because I was about to give you the entry to, this model. But basically, once you have all of these liquidity levels mapped out, you know where the magnets are. How do you trade them? How do you get an entry out of them? Well, the first thing that you're going to do is align your time frames. Okay? So here are the time frame alignments. Okay? Daily PD array, hourly change in state of delivery. Okay, let me just write that out for you. Okay? 4-hour PD array, 15-minute change in state of delivery, right? 1 hour PD array, 5-minute change in state of delivery, and then 15-minute PD array, 1 minute change in state of delivery. Okay? So now that you know time frame alignments, okay, well, we're not trading PD arrays right now. We're trading liquidity, but you should know this. So if you are trying to get an entry using liquidity, what you would typically do is use the higher time frames, right? I prefer the hourly. So I would use the hourly. If I wanted to trade, let's say I wanted to trade this, okay? Right here. Okay. So price ends up sweeping this high. Also, I'm just giving you an example. All right, I didn't trade this, but if you wanted to use liquidity to trade, this is how you would do it. Okay, so you can see there's SMT here, right? Because, right, price swept this high on ES, but did not sweep this high on NQ. Okay. When I say this high, I am referring to this high right here. This candle. Right? You see on ES, price swept it, NQ it didn't. Okay? Now, if you've been following me, you know my entry model is liquidity sweep, right? Higher time frame PD array, lower time frame change in state, and SMT. So I'm just showing you how to trade liquidity here. I'm not using the PD array. So this is what it would be. It'd be liquidity sweep, lower time frame change in state of delivery, SMT. Okay, so this is on the hourly time frame. We have that SMT, we have the liquidity sweep. What else are we looking for? We need to align our time frames. So the 5 minute is aligned with the 1 hour. Go down to the 5 minute and find a change in state of delivery out of that high sweepage. So what is a change in state of delivery? For a bearish change in state of delivery to be valid, we need a candle closure under the series of up-close candles that swept highs. This is that high. This is the series of up-close candles that swept highs. So this would be our change in state of delivery level. We confirmed that change in state of delivery with this candle right here because this was the candle that closed under that series of up-close candles that swept highs. You see what I'm talking about here? So this would be your entry. Short right here on this candle closure, you would target 2R. Wait, you put your stop at the high, protected high. You would target 2R right there. And this would be the trade completed. So this is exactly how you can use liquidity to take trades. I personally don't trade liquidity, but I have before, and it works like a charm once you wait for the change in state of delivery, because that's confirmation. But to sum up this video, this is everything about liquidity. I know I went kind of off topic here with entries and internal and external, but all of this stuff is necessary if you want to become a trader and you want to know what is happening inside the market. You need to understand all of these topics to have a full understanding of what price is doing and how you're going to react to price going forward. Okay? So essentially, to sum up this video, you're going to find liquidity, right, using your higher time frames because higher time frames build your narrative. You're going to wait for a sweep, okay, for an entry. You're going to wait for change in state of delivery on a lower time frame, and then you're going to have SMT in there, and that is going to be your entry and how to trade liquidity. But this video should have summed up liquidity, everything about it. Remember that liquidity is just highs and lows, okay? It's just buy stops and sell stops, and price reacts off of those buy stops and sell stops. I can draw some more liquidity levels for you just so you understand. This is more of like a lesson than it is a YouTube video, but like right here, this is buy side liquidity. This is also external range liquidity. This is also external liquidity. It's all the same shit, okay? Right? This is just liquidity. This low. This is liquidity. This is sell side liquidity. This is where sell stops are, and this is where buy stops are. All right? That's just the nature of what liquidity is. This is also liquidity. This is liquidity, right? This is liquidity. All this is liquidity. Lows and highs and lows and highs, right? So all of this is liquidity. Find a major liquidity level. Find a lower time frame change in state of delivery out of that liquidity level with SMT, and that's an entry that you have right there. But basically, this was liquidity, everything you need to know, simplified. This is going to go into a section of my YouTube channel that I am going to focus on, all these concepts. And after a while, you'll have my YouTube channel will just be a library of assets that you can use whenever you're confused about a subject. So I hope this video helped. Subscribe down below. Like this video. I plan on making so many more videos just like this one. I think they're super helpful, and I hope they helped. Have a good one.